as we pivot to the U.S., this is really where we start to hone in on, where things are, looking at gasoline, kerosene, obviously jet fuel, distillate, residual. And this is where we've been kind of saying we would shake out of that 14.6 million barrel a day demand level on a continuous basis. And you can see that the 4-week rolling average is starting to shake out right in that ballpark. And that's something that we think is going to be very stable. This past week, the demand was 14.497, if you want to be specific. And then last week was 14.66 million barrels a day. So again, right in line in that level. And 2021, as we've been trying to highlight, 2021 was driven by not really gasoline, but that distillate demand, that diesel demand, because of the massive surge in trucking. That has since diminished, as we talked about on the FSC show, and we're going to talk again tomorrow. Demand for trucking has dwindled significantly, and that has pulled a lot of that diesel demand that was well above normal back into a bit more of a normal range. Still elevated, but well within the threshold of where we've been over the last 5 years. So mixed with distillate, with gasoline, about 400 to 500,000 barrels below normal, mixed with jet fuel, about 200,000 barrels below normal, you get an idea of, instead of being at about 15.5, we're at about 14.5, 14.6, about 1 million barrels a day off of normal, which is what we think is going to persist, obviously weather dependent, on where we're going to be through the end of the year. Obviously, we'll get our seasonal spikes when it comes to Thanksgiving and when it comes to Christmas, but it's still going to average out to a much weaker period of time versus what we saw in 2021 and then 2017 through that 2019 period. Distillate, and obviously another key piece to all of this, which we'll talk about in a minute, is price. And you can't ignore the price side of the equation when you're looking at where we are on the gasoline front and the diesel front. The problem is, from a supply chains perspective, we have no choice. Everything is moved on the back of diesel. So that gets included in a lot of these prices, and I did a TV spot, which we'll share in a little bit, where it's funny because when I went trick-or-treating with my kids, we picked up some of the candy, and I was like, wow, these small pieces are even smaller than normal. And when I got home, I said to my wife, I was like, did you? She's like, she's like, yes. She's like, they're tiny, they feel like they weigh nothing. I said, yeah, and again, that's shrinkflation. It's trying to reduce the total ounces and volume to try to keep prices as stable as possible without showing or at least seeing the same type of pain. And a lot of this is on the back of distillate and diesel costs and obviously labor and all the other issues, which we'll talk about tomorrow. But distillate had a build of 430,000 barrels. That's still 24.5 million below the 5-year. And as you can see, it still is driven 97% by Pad 1. Pad 1 had a build of 1.4 million barrels, but it's still 18.9 million below the 5-year, 15 million below the last year. And as we talked about, the pivot point for Pad 1 was the explosion of the Philly refiner in June of 2019. That was when we really started to see those issues, and we highlighted that imports were going to have to increase to offset that. And then what happened? Well, everybody needed more imports, and then Russian product came off the market. And now we're sitting in a position that is very concerning as we head into the winter season, especially with Pad 1A, New England, Pad 1B, essentially New York to the lower mid-Atlantic, and then 1C is below that. But Pad 1A and Pad 1B continue to be a huge problem when you look at the consumption of heating oil. Imports had a small increase into Pad 1 of 30,000 barrels a day, but it's still well below the 5-year average, and a lot of that is driven just based on cost. So because prices have gotten so much higher, it has actually made sense to put diesel and onto Jones Act vessels. So there are 2 vessels, one heading to New York, one heading to Charleston. And just given based on the fact that rail has been increased, we'll talk about that in a minute. We've had a maxed out Colonial Pipeline, which again goes from Gulf of Mexico, terminates in Linden, New Jersey. So now the only other option is pay whatever the going rate is on the Jones Act vessel. But if it makes more sense to, instead of going to a Jones Act, go into the international market, they're going to try to maximize value. And going into the export market is a secondhand way of reducing prices, going and making a bit more product available for Pad 1, because we're taking some of that demand away from Europe, which allows international capacity to come into the U.S. Distillate fuel oil, again, Pad 1 had a build, but it just doesn't matter. I mean, when you look at it, if we were to get to the lowest level, it would take about 10 million barrels to get back to the lowest point. When you look at just the underlying problems in general, just to close this gap. So you see just the how much of a dire situation we're heading into. And again, if we have a warm winter, this will be a problem for price, but not as much for availability. If we have a normal or cold winter, this is going to become a very stressful situation for many in the New England area. Fuel oil in Pad 3 is fairly normal. Obviously, when you look at it, there were 3 years that were higher. And obviously one of them being 2020, but realistically, we're in a fairly comfortable spot. But the issue is getting it from the Gulf of Mexico into the demand centers of Pad 2 and Pad 1, the Midwest and the East Coast, which is why we expect to see those exports remaining a bit elevated as they try to manage some of those flows, and they try to, again, maximize production. So production of distillate increased 1.5%, about 0.06%. Increasing yield by about 140,000 barrels a day, because they're going to try to eke out as much of the distillate cut as possible, because that's where the margin is. Everybody wants to make money, and that's where they're going to try to create the most value. Now, when you look at the product supplied, you can see that there was that bounce back. We expect it to stay fairly close to the 5-year average, and a lot of that is just going to be driven based on where that volume sits and how those movements continue to adjust. And the movements is important because when you look at the trucking demand side, you can see how we have fallen significantly from the peak of 2020 and 2021 down to where we were, as if you look at 2018, 2019, the problem is the data is showing us going closer to 2019 levels, which was a fairly weak period. And that's where we see more pressure on the trucking side. They're not rejecting tenders. They're just taking whatever work they can, and they're eating some of the additional costs on the diesel front just to keep their trucks in motion. And that's going to be an interesting one to watch as we progress through the remainder of the year, because remember, this is peak period. October into November is peak period for trucking to move stuff into position as we head into holiday shopping. Now, this is an important one when you look at rail traffic. Rail traffic on the intermodal front is coming close to where we were in 2021. Again, as less is moving on the roads, a bit more is moving on rail, because there isn't a time crunch the way there was, so you can wait. The petroleum products up 6%. That's going to stay elevated again as they try to move things around. Grains increased. The problems on the Mississippi is going to put more on the rail as well. So that will stay elevated. And then that's also, again, pushing more across the board. So total traffic is actually now above where we were last year. And a lot of that is just because there's more time. So I don't need the truck right away, so I'll just put it on a rail. And a lot of that is also the Mississippi relying more on the rail instead of the waterways and barges. So that's something that will stay elevated. And again, it's just another small piece of the diesel consumption side. On the shipping front, you get an idea of just how much lower it's going. And remember, these are peak periods. And this is when you look at where we are, we're actually below incoming TEUs or containers were below where we were in 2019, which was already a weak period. So that's the bullwhip coming full circle. And back to our comments from Masaryk, they're seeing a decline for the year of 2 to 4% and a weaker guidance in terms of volume. So at first they saw a decline of 1%, plus or minus 1%. Now they're seeing a decline of 2 to 4%. Based on everything we're seeing, we're much closer to the 4%, probably 3 to 4% decline as we head into year end. And again, that's for the year, to give you an idea of how bad Q4 is, because Q1, Q2 had an increase, and now things have dropped off at such a faster rate that is creating some of those additional problems. On the temperature side, you can see that things on the East Coast are massively above normal. I think it's supposed to be in the 70s as we head into the middle of this week. But you're starting to get a lot of that below temperature further up. This is showing you something. Again, this is not great for natural gas consumption. This isn't good for distillate consumption in terms of, it's good in the sense of you'll put a bit more into storage, but when you look at the below side and you look at the north, you're starting to see that winter weather come through, and a lot of that should progress, and we should come back closer to normal as we get into the second and third week of November. But a positive start if you're considering where we are on the distillate storage side and the natural gas storage side and pricing front. Gasoline stocks fell 1.26 million. That's 13.6 million below the 5-year. And that was driven again by Pad 1 with a drop of 890,000, which brings us 8.4 million below the 5-year average. Imports, again, dropped 368,000 barrels a day. That was driven by Pad 1 with a drop of 186,000. And as we said before, it's because it makes the most sense to move distillate and diesel all around instead of putting gasoline, which is why we have so much gasoline stuck in Europe, and we have some of these shortfalls on the East Coast, putting us at a fairly normal along the 29-year average. But when we look at Pad 3, Pad 4, Pad 5, things are normal against the average. So again, it's being driven by that Pad 1 side, and to a smaller extent, Pad 2. Gasoline inventories, looking at it across a slightly different way, you can see just where we are in comparison to other years. But then when you look at driving demand, things in China have remained fairly stable. Again, there's still a lot of uncertainty. We'll talk about the economic data tomorrow when we look at China, which continues to weaken. And then when you look at Asia Pacific, that we're seeing more of a drop off on the TomTom side, as North America again stays fairly stable, with Europe right around the norm, back to the normal levels, which is a net positive. But when you look at price, so gasoline prices have started to normalize. They're still about 20 cents above, about 15 cents above where they were at the lows. But you're still well above the 5-year out, like throughout the last 5 years. Going back to 2018, you get an idea of where we are. But diesel has stopped going up, but it has not come down with gasoline. And this is something that's going to be a sticky point. As we've been saying, diesel prices were going back up. We're now at $5.31. This has even overshot our estimates. Our view was that we were going to get to about $5.15. When we came to about $4.95, we're like, no, we're going to go right back above 5. And as we got into the winter months, 5.10, 5.15, we thought was going to be a good position. But here you can see we're at $5.31. There's probably some opportunity for some softening in price, but not much. And that's going to be the biggest overhang, especially when people get that sticker shock when they start getting their deliveries for heating oil. Blending components, fairly normal when we look at gasoline blending. They came in at about with a draw of 1.97 million. That's only 6.8 million below the 5-year. We expect to see that start to come back up, especially as the glut on the NGL side picks up a bit. And as petchems continue to remain under pressure, we don't see that picking up, and that's going to push some of that product back into the blending components side. Now, when we look at gasoline demand, you can see that we're below where we were in 2016 and 2012, and we're just going to stay at these levels. We'll bounce back and forth. Like, it's not a straight line. We could go to 18.8 and then go back to 8.8, then back to 8.5. But realistically, that 8.6, 8.7 level is going to be a very comfortable point for the foreseeable future. And a lot of that is driven when you look at workplace and transit. When you work at workplace, we're still 20% below normal, and that's going to continue. And then as the weather impacts, because we did have an unseasonably warm beginning to fall, we did have more opportunity. This week is going to be a lot of the same. That's going to keep people active, and that's going to be a bit of a tailwind. But again, the transit side, the workplace side is that headwind. Propylene had a build of 1.23 million. That's 3.2 million above the 5-year. You can see that we're right at the 5-year average, just above the 5-year average. If we take out 2016, we're right at the 5-year, and that's something that is going to continue to drift higher as weather continues to be a bit normal, weather a bit above normal in terms of heating degree days, heating demand in general. But also the increase in supply, which is we'll talk more about price on the FSC show. Jet fuel, here you can see that there was the small build in jet fuel of 340,000 barrels. But on the demand front, it just, again, averaging it out, it's just going to stay between that 1.45 and 1.55. As we look at the passengers' movements, we're just below the highs or the norm of 2019, but it's also important to appreciate that 2019, the end of 2019, wasn't really a good year. Like, we started to see the pain coming through, and it's starting to get a bit more closer to normal. You're still having lows that are below 2019 lows, but the highs are getting much closer in terms of where it is. And as we go closer, we think this is going to mirror 2019 a bit more closely, or a bit more along those lines. And when you look ahead, passenger flight schedule for the 12 weeks ahead is 1% lower than it was last week. The number of passenger flights over the week from October 18th fell by 2.17% week on week. So still below normal, but again, still closer to normal than we have been, and we expect this to remain fairly stable. When we look at open table, starting to see a bit of a slowdown in terms of just activity. Some of that is weather related. Some places have taken their tents down for that outdoor seating. Some people, and we'll talk more about this in the econ show, is people are getting a bit more cautious and not spending to eat out as much as previously. And I think a mixture of just the cost of eating out remains elevated, but also saving a bit more for holiday gifts. So you're going to get kind of that movement of the way people are going to spend their discretionary capital. So that's what we have for you on the U.S. front. In the next segment, we're going to go abroad and look at how things are changing in the global market and how the U.S. fits in within that threshold.